In this video, we're going to get into the 5 best gold ETFs for growth potential, diversification, and even high income. The price of gold has really increased over the last decade, especially in the most recent years. This strong rally came from a variety of different reasons, such as the high inflation environment over the past years since the pandemic, the variety of geopolitical conflicts that are ongoing, along with those that may have come and gone, a slowing labor market, and the additional uncertainty from trade wars are a list of a few things that have played into this. And for those that may be interested in getting some exposure to gold, there are actually a few different options of different types of gold ETFs that you might not be aware of that we'll be going through. So let's get started. First up, we have iaum, the iShares Gold Trust Micro ETF. iaum seeks to track the performance of the price of gold. Gold has been a key asset for many years, and over a long time period, it's provided a variety of benefits to investors like liquidity, diversification, and hedging against inflation or any other economic or geopolitical issues. Gold, along with other precious metals, are not only investment vehicles, but a reliable store of value during great and challenging market environments. And instead of actually purchasing physical gold, you can invest in a physically backed gold ETF, which these ETFs own the gold and it's stored in vaults. So why invest in iaum? Well, it's one of the lowest costing physical gold ETFs currently on the market. It also gives exposure to the day-to-day movements of the price of gold. And it can further help to diversify a portfolio and help protect against inflation. iaum tracks the gold spot price using gold bars that are held in vaults all around the world, and it's an efficient way for investors to hold physical gold. This fund removes the complications for investors when it comes to buying, storing, and insuring physical gold. Since iaum's only asset is gold bars, you aren't going to find a list of holdings that you would with other ETFs that hold stocks or a variety of other assets. But this fund does come with a fee, as it has an expense ratio of just 0.09%, costing $9 for every $10,000 invested, making it one of the cheapest funds for exposure to gold. Before jumping into the returns, I do want to mention that iaum was created in 2021, so it's only a few years old. So when it comes to the longer 10-year performance, I'll be using a similar ETF called IAU from iShares as well. iaum is the micro version of IAU, and they're basically the same. But the difference is that IAU has a higher expense ratio of 0.25%, and it has more assets under management and liquidity, which is more important for traders. So getting to the best part, which is performance, IAU, the bigger one, has had 10-year returns of nearly 13% over the last 10 years, and over the last 5 years, about 15%. And if we zoom in more recently using IAUM's data, it's had annual returns over 31% in the last 3 years. And if we take a look at its returns, in 2025 alone, it's had over 50% in returns so far this year. That's some pretty incredible growth it's had in 2025. And like any investment, the price of gold will fluctuate, but if you're someone that's looking to get exposure to gold in a simpler way, whether that's for its potential growth that it could provide you, its added diversification, or its store of value, this is definitely a solid fund. Also, here's a list of some other gold ETFs that you can come back to and take a look at later on. Next, we have GDX, the Van Eck Gold Miners ETF. GDX seeks to track the performance of the market vector Global Gold Miners Index, which tracks the overall performance of companies that are involved in the gold mining industry. And the fund invests at least 80% of its total assets in holdings that make up the Gold Miners Index. The Gold Miners Index is a modified, cap-weighted index made up of companies that are primarily involved in the gold and silver mining industry. To be initially eligible for the index, companies must generate at least 50% of their revenues from gold and/or silver mining, royalties, streaming, or have at least 50% of their mineral resources related to gold and/or silver. The weight of the companies with less than 50% exposure to gold-related activities will not exceed 20% of the gold miners index at rebalance. One thing to keep in mind with gold miners is that they have some operational leverage over gold ETFs, which has helped them to outperform gold ETFs. Since miners mostly have fixed costs, a small increase in gold prices can make a big percentage increase in margins and earnings. AISC, or all-in sustaining cost, measures how much it costs miners to dig up each ounce of gold from a particular mine. So when the price of gold is higher than the AISC, those additional dollars are essentially what drives the profit margins. For a straightforward example, let's say a miner has a AISC of $1,000 per troy ounce of gold. So when the price of gold is $1,500 an ounce, then the miner's profit is $500 an ounce. So a 33.3% profit margin. And if the price of gold increases by 50%, so now it's $2,250, then the miner's profit is now $1,250, which is a 120% profit margin. So a 50% bump to gold increased profits by almost 100%. This is how rising gold prices can increase miner stock prices more than gold itself. Getting into the portfolio of GDX, this fund contains a total of 52 holdings, with top holdings in big gold mine names like Agnico Eagle Mines, Newmont, Goldfields, and Barrick Mining, along with gold royalty firms like Franco-Nevada and Wheaton Precious Metals. Unlike gold ETFs, this fund pays a dividend, and it has a dividend yield of 0.51%, which it pays out annually. When it comes to the cost, GDX has an expense ratio of 0.51%, costing you $51 for every $10,000 invested. While gold has done well, gold miners have managed to do even better when it comes to performance, with annual returns of over 19% in the last 10 years and 49% annually over the last 3 years. This fund has experienced a crazy run-up in the last couple of years. If you're looking to diversify your portfolio and have some leveraged exposure to gold price through gold mining companies, GDX could be the one to look more into. Next up on the list is btgd, the STKD 100% Bitcoin and 100% gold ETF. btgd offers long-term capital appreciation by investing in two complementary investment strategies, and that's a Bitcoin strategy and a gold strategy. So it's a leveraged ETF that's designed to provide 200% exposure split between Bitcoin and gold. So for every $1 invested, the fund aims to provide $1 exposure to Bitcoin and $1 exposure to gold. So why invest in btgd? First is as an inflation hedge, since it could potentially help to preserve purchasing power during inflationary periods. Second is currency defense, as it seeks to provide exposure to assets that are historically used as potential hedges against currency devaluation. Third is a fiscal dominance hedge, since during environments of fiscal dominance, the more scarce and limited, so harder to replace assets like Bitcoin and gold are often used as a hedge. And last is as a market volatility buffer, since gold stability has the potential to offset Bitcoin's volatility for a more balanced approach. Now, btgd aims to provide exposure across a variety of assets, so it primarily invests in Bitcoin and gold futures, Bitcoin and gold ETFs for direct exposure, cash, and then reverse repurchase agreements. If we move over to the holdings that make up this fund, you'll see what I mean. Starting from the top, you can see we have Bitcoin futures, then gold futures, the obligations fund, which invests in those repurchase agreements, cash, gldm, the Spider Gold ETF, and then two Bitcoin ETFs, Fidelity's FBTC and iShares IBIT ETF. Now, since the market naturally fluctuates, this causes portfolio drift, where the percentage weights of assets may shift away from the targets that are set by the fund. For this reason, the fund will be rebalanced when needed, so this could be once or a few times a week, depending on how the market is. btgd does happen to just barely have a dividend, as it has a dividend yield of 0.11%, which is paid annually. For the fees, btgd has an expense ratio of 1.05%, costing you $105 for every $10,000 invested. Now, that is a little bit expensive, but keep in mind this is a leveraged ETF that's actively managed. Moving to the performance, this fund is still very new, as it's only been around since October 2024, but since it's been created, it's had total returns of around 130%. Some really amazing results since it's been out. btgd can be a complement to a diversified portfolio, as well as it could be used to hedge risk with some potential outsized returns. But with that being said, it's important to consider the risk when it comes to leveraged ETFs. While holding a leveraged fund, you can expose yourself to large losses when you have multiple days of downside performance, which may not be fully recoverable. For example, with a 2x leveraged ETF, the ETF will mimic the index it tracks by a factor of 2 times each day, and that 2x goes both ways, up and down. And when it comes to drawdowns in general, while a 2% drop with a 1% rebound isn't a big deal, having an 8% drop and a 4% rebound is a slightly bigger issue. For every drop, you need a bigger percentage recovery to bring you back to break even. So even if the rebound is bigger than what was lost the day before, even with leveraged ETFs, you can still end up underwater and falling below break even. This decay or erosion is important to keep in mind for leveraged funds, as it can really build up over time when holding over long periods, and it adds much more to its risk factor. If you understand and you're okay with this, btgd could be a nice ETF for you to look into. Next, we have gdxj, the Van Eck Junior Gold Miners ETF. gdxj aims to replicate the MVIS Global Junior Gold Miners Index, which is composed of small cap companies that are involved in the mining of gold and or silver. So why invest in gdxj? First is for small and early stage miners. This fund holds a portfolio of small gold miners, with some being in early exploratory stages with higher potential upside. Second is for the high beta exposure to gold prices. Like I explained earlier, with the ETF GDX, gold miners provide leverage exposure to gold prices, allowing for even higher potential returns than you'd get for only having direct exposure to gold. And third is that gdxj is highly liquid, as it has a greater average trading volume than any other junior miner holdings. As for gdxj's portfolio makeup, this fund has a total of 98 holdings, and the top holdings of this fund are Core Mining, Pan American Silver, Equinox Gold, Royal Gold, Evolution Mining, and more. So this fund is focused on giving you some diversified exposure to mid and small cap mining companies, unlike its bigger sibling GDX, which is more geared towards those larger companies. This fund also pays you a dividend, as it has a dividend yield of about 1.08%, which is paid annually. And for the fees, it has an expense ratio of 0.51%, costing you $51 for every 10K invested. gdxj has had a very strong performance recently, with annual returns of about 19% over the past 10 years. And more recently, in the past 3 years, it's had annual returns of over 51%. To give you a better perspective recently, if we look at the returns in 2025 for gdxj along with GDX compared to gold and the S&P 500 Fund VU, you can see that gdxj has had an amazing run-up, more than doubling the returns of gold, which has been well outperforming the market this year. Gold miners are operating in a very favorable market right now, and if you're looking for some exposure to some smaller gold mining companies that have the potential for some high returns, then gdxj could be one to take a look at. Next on our list is igld, the First Trust Vest Gold Strategy Target Income ETF. The objective of this fund is to track the performance of the Spider Gold Trust while also providing consistent monthly income for investors. An igld strategy has 2 key parts to generate that income. First is that it invests in short-term, 1-month treasury bills, and then second, the fund utilizes flex options. Unlike standard options, flex options let investors customize the strike price, the exercise style, and expiration date. The way IGLD's option strategy works is that it targets synthetic exposure to the price performance of GLD by using a combination of flex options, selling put options, and buying call options. The way this process works is that the fund will buy call options and sell put options in order to be exposed to both the upside and downside price movements. So this is where the synthetic exposure comes from. To protect the strategy and raise income potential, the fund will use a partial covered call strategy by selling at-the-money call options on GLD to cover short positions. This acts as a hedge against market declines, and by selling call options, the fund aims to generate additional income through option premiums by turning some of GLD's growth potential into income. For the holdings for igld, it's primarily going to be US Treasury bills along with those flex options. And instead of directly purchasing shares of GLD, the Spider Gold Shares ETF, igld does it through a subsidiary in the Cayman Islands that purchases flex options. Getting into the income, this fund has a dividend yield in the double digits of 14.6%, which is paid out monthly. And that's due to that income that's generated from its covered call strategy. For the fees, igld has an expense ratio of 0.85%, costing $85 for every $10,000 invested. This higher fee is to be expected from an actively managed fund. As for performance, since igld has only been around for a handful of years, it doesn't have a ton of history, but it's had total returns, including dividends, of over 86% in the last 3 years. And so far in 2025 alone, it's had returns of around 40%, really optimizing those gains from Gold's run recently. For investors that are looking for high monthly income and potential for capital appreciation that comes with the exposure to gold, then igld could definitely be one to look into. But if you're not sold on gold ETFs and you want some more options on the best ETFs that have outperformed the market, then check out this video here. Or if you want to see the best one ETF portfolio to buy and hold forever, then check out this video here. As always, I appreciate you watching, and don't forget to tap that like button and subscribe, and I'll catch you on the next one.